Collections Technology Think Tank Virtual Event 4.2. For those of you who've just joined us, you missed a session 1, where we looked at collections, risks, and strategies in the first session. That will be recorded and will be available post this event, probably usually within 24 hours for on demand. So if you want to watch that or this one again, then you can do that. We also have a YouTube channel, but we tend to wait a good 3 to 4 months before we put them on our YouTube channel as well, long term. So yeah, thank you. So just want to welcome you back. Those of you not familiar with our platform, I'll quickly run through it. So on the left-hand side, we've got information on the event. We've also got a speech bubble option. So we really want you guys to interact on that with your questions. We had a lot of questions in the last one. So I always think it's a good measure of how well it's doing out there externally or stuff we're not covering. So that's good. We've also got a little indicator where you can look at the information on our panelists and some info on our sponsors today. So thank you for that. But let's crack on and talk about our next discussion topic, which is business transformation. We've got some really good speakers lined up for this session, so we hope you enjoy it. But to introduce those speakers, and more importantly, to keep the flow of the conversation going, I'll hand over to our chair for the day, which is Chris Warburton from RS Strategy. Chris, over to you.
Thanks very much, Colin. So welcome everyone to the second session of the day, so around business transformation. I suppose we heard in the first session quite a bit about all the changes that are coming our way, be it potentially increasing volumes, definitely increasing financial stress for some customers, different conversations being happening with customers, with cost of living, etc. coming up, cost pressures, there's regulatory pressures, things like consumer duty that's coming down at us as well. So how do we all react to that? That's what the topic of this is going to be. How do we transform our businesses? How do we think about transforming our businesses? So that's going to be this conversation for the next 50 minutes or so. And with me, we've got 3 great speakers. We've got Neha, Bhat, who's the VP of Credit Risk at JP Morgan Chase, obviously in the banking sector. And we've got Dan Calcott, who's director of the Digital DRA, the Debt Resolution Agency, obviously looking around like solving and supporting customers who are in debt. And then we've got Kevin Still, who's the director of DEMSA, who's the Debt Management Standards Association. So Kevin, Dan, and Neha, thanks very much for joining us. So and I suppose to start the conversation, I was going to really talk a bit about going back to the cost of living and the impact, and what are some of the things that you're kind of seeing in your portfolio or in your company in terms of how that's sort of flowing through me. And maybe Daniel, maybe just start off in some of the things that you've been seeing, I suppose, from your experience.
Thanks, Chris. Well, from our point of view, I think the most obvious in relation to the cost of living is we're seeing a decrease in a customer's disposable income. So to give a real world example of this particular client we have, in comparison to 6 months ago, we're seeing just under a 25% decrease in the payment value, which is quite a significant jump. But in the grand scheme of things, obviously it makes sense with the price increases across the board. So yeah, I think for us, disposable income is definitely a hot topic and one to keep an eye on at the minute with everything that's going on.
And I suppose, Kevin, from your point of view, I mean, you obviously talk with a lot of people in the debt advice space. I mean, what are some of the things people are seeing there in terms of cost of living, and particularly, I suppose, what is the driver of the cost of living? I mean, because that feels like that's kind of changed, and we talked about on the last call a little bit about it used to be food, and then it was energy. Now it's mortgages that we're worried about it. So it feels like it's been a bit of a moving kind of topic to a certain extent. But what are you hearing from your members?
So I think for those that saw and listened to Gareth on the first session, where he's dealing with people very much in the bottom quintile of society, and the dreadful number of people with deficit budgets and significant deficit budgets, but his indication that this may well be a barometer of other demographics. And I think Step Change's figures in January, when they had a record year, pay plan indicating they're seeing a much more significant number of people with relatively high, household income 60,000 plus as a meaningful proportion of people seeking debt advice is a sort of barometer that we're seeing not only more people approaching for debt advice, and it's taken them a long time, which Gareth indicated, sometimes well over a year for people to come off and seek help after they've used up all the coping strategies. But what we're then looking at now is rise in not only deficit budgets for certain proportions, higher penetration of priority debt, energy debt in particular, council tax debt, early signs on some mortgage arrears, but the earlier barometer is probably in the private rent sector, where some of the pain is being pushed down. Private rent costs as a proportion of gross income as well as net income going up. And Gareth also indicated very clearly there that for those in the sort of bottom 2 quintiles, when you look at them relative to the standard financial statement, food is about 20% in terms of inflation, not at the headline rate. So it's impacting certain groups of society in a much harder way than looking at it as an aggregate level across the whole of the sort of Bank of England ONS figures. But there are definitely certain customer cohorts that are feeling distinct pain. And the interest rate rises for fixed rate, we've seen 800,000 likely to be impacted this year, 1.5 million next year. And when it was, thought to be a cap at 4.5%, and we're now forecasting 6% by the end of the year, those figures are likely to get worse, where the average increase in cost for a mortgage was 350 quid. That's probably going to be upwards of 400 now. That's a big chunk out of your disposable income, as Dan said. And if you're an unsecured creditor, you're likely to take a hit on some of the time to pays, not only in terms of their sustainability, but also whether somebody can actually afford anything at all. So the Borrowers in Financial Difficulty consultation, which closes next week, follows closely on from the duty, Chris. We've talked about this before. There's some serious things hitting the industry in the first half of 2024.
I mean, it seems like there's an awful lot going on, and I suppose Neha, I'm interested from a lender point of view and from a credit risk at a lender point of view in terms of how do you kind of see that in terms of the dynamics around cost of living? I mean, is that changing the way banks are going to have to interact with borrowers? I mean, even as you get upstream from the collections and the debt advice space. I mean, what are the emerging? I mean, are these new emerging risks we haven't seen before?
I think it's a confluence of different risks, frankly. So, what Kevin and Daniel just highlighted, it's all alluding towards affordability crisis. There's a mortgage shock, there's a payment shock. So, definitely from a credit risk standpoint, there's a need to be on top of those affordability, mechanics and what affordability buffers are in place and how to adjust for them. And likewise, the approach to credit risk has to be, quite stable. So, you have to look at those adjustments and weigh in the macro factors. So I think affordability adjustments is something that would be vital. And then, looking at industry, broadly CRA data, you are seeing early uptick in, delinquencies with regards to mortgage and some creep ups within cards. So I think the approach to credit risk has to be robust, and it has to be tied to the dynamics on the affordability front, so that both credit actions can be more thought through and factoring these changing dynamics.
And how much can it be anticipated? I mean, so we're again just even looking at interest rates. I mean, I think we're saying, look, it's like inflation is going to peak at a rate, and interest rates are going to peak at 5%. Now they're talking about it being 6%, and it's feels like the economic forecasts. I won't say they're getting it wrong, but it's kind of like it seems like it's more difficult to forecast than maybe they thought, or we naively think maybe. I mean, how much of a problem do you think that presents for lenders from a credit risk point of view, because you're balancing that against, I suppose, the loan book as well, aren't you? So I mean, is stability an island of stability still something that we're searching for that would really help?
Yeah, I think yes. What should be expected more broadly is, there would be a wider divergence in affordability and wealth to look here. So I think that's a given, right? That is expected. Some marginal low income, low affluent households are affected, and that's likely to continue. And consumer confidence is likely to be uncertain as well. I think that's also something that's likely to continue. So while the economy might look stable, but these trends are here to stay for a bit of for short term when it comes to affordability and divergence in wealth. So,
I mean, Dan, I was going to ask you a little bit about. I mean, does that mean that we have to almost like think about our businesses in a different way? I mean, is it a different kind of almost like segmentation of the portfolio than we had before? And I mean, do you see some of that? I mean, I know you've been heavy sort of in the digital space, sort of using digital channels to get hold of people. I mean, but is it just, I mean, is that intuitive? Do we need to think about our portfolios maybe in a different way and think almost like digital, non-digital, different types of income groups? People are more affected by, say, for example, food costs or energy costs versus those that aren't, or those kind of things. I mean, do you see some of that, or is you think about it the right way?
Potentially, I think Kevin's kind of touched on it there, that we're going to start seeing almost a different kind of demographic falling into this space that might not necessarily been here before. What we kind of find in terms of the digital aspect is 99% of the time people will engage with us digitally. We reserve the phone for circumstances where we're unable to resolve that account digitally. But the vast majority of the time, people can and will engage with us digitally and are able to do it that way. But so I think the approach in general needs to be considered rather than the channel. I think that the whole approach, because you've got these different kind of demographics falling into this process that might not necessarily ever been here before. I think that's why the approach needs to have a lot more focus on that.
So you're kind of saying like the digital non-digital split, which was always used, is sort of like it's disappearing to a certain extent, and you can.
I think so. Yeah, I think so, and I think the focus now is more on the language used and the approach, and when you're actually engaging with these customers, what you're speaking about. Are you asking the right things? Are you reaching the right outcome? I think that's where the focus is right now and should be for the foreseeable.
And Kevin, I suppose you get your view in terms of like the segments we used to think of our portfolios. And I mean, are we thinking about those still in the right way? Because it almost feels like there's new segments coming up. So digital, non-digital was one that used to came up, or age or demographic would be one that would come up. Or maybe but do we need to start thinking about that in terms of, I mean, affordability would be one, but then it's also exposure to particular sectors within expenses as well.
Well, I think going back to the discussion at a higher level on terms of clients, I think you're going to look at it between expected risk and unexpected risk. If I go back to my old Equifax days, that's what you're looking at, is what sits in the unexpected risk pool. And this is where we're seeing sort of new behaviors, new cohorts coming into play, where in many instances, events have occurred that are entirely outside of their control. And anticipating that and looking at things like pre-arrears strategies, crystal balling, is a large part of what the regulator's looking at now in terms of anticipating borrowers in financial difficulty, often from segments that you would never have expected before. So some of the recent policy rules around insurance, which only came out last week, was for insurers who are historically very reactive. How are you going to start looking at something that says, I've got clients here beginning to drop cover that they really ought to have in place? Is this an early barometer of a bigger problem? But how do I intervene? That challenge has been in play with persistent debt on credit card providers, but you've got to separate between somebody who does always carry a balance, does always pay the minimum balance, that was always in their intent, versus being an unintended consequence, because the reality is they can't afford to pay any more than the minimum payment. So data analytics, looking at unexpected risk areas, is a big part of the regulator focus. but then drilling that down to actual behaviors for agents, virtual solutions is absolutely crystal clear. So we go back to things like the mortgage change. Should it be difficult to ask somebody, are you on a fixed rate mortgage and you're a homeowner? And when is your rate going to change? That's a well-known horizon scan question that most creditors, collectors, debt advisors should be asking. And what's the consequence of that? So if we know that you've just set a time to pay up that's 12 months long, but you've got a catastrophic event occurring 6 months out, then, you know, tools like Dan's would be predicting that and said, right, I know I'm going to get a lower yield. I know whether this is going to be sustainable or not, but I now do need to take some proactive action. So, you know, coming out of all the things, the events we've got at the moment, there are a number of areas that you can push those down, whether they're agent assist tools or agent tools, to actually start capturing some of this information. And as Gareth said earlier on, using tools like social tariff calculators proactively. Now, let's face it, the Priority Service Register is a pretty black and white tool. Are you over a certain age? Yes. Have you got X kids? Yes. Are my circumstances Y? Yes. Now, why aren't we using some of those bits of information to anticipate challenges where it clearly highlights certain groups that are always going to be perpetually at risk, which is our traditional clients, people who are in and out of collections all the time, versus those at risk of being in collections for the first time? But you don't have to be a rocket scientist to do some of the basics well.
And I suppose these new emerging risks that sort of come through the conversation, etc. I mean, Neha, I'll come back to you in terms of, like, suppose acquisition credit risk versus in life cycle risk, where these things kind of change. You have unexpected events. You have this almost like creeping kind of change of risk. I mean, what's the best approach around capturing these new indicators, putting those into the models, and how much emphasis would you put on trying to get to people before they go into collections as well? I mean, that feels like it's been an increasing area we've always talked about, and Kevin talked a bit about persistent debt there as well. But it feels like something we talk about, but there's probably more that we can also do.
I think, yeah, and engaging with customers early in the way that is in a way that kind of builds that emotional trust with customers is vital, and collections is no different to that. The consumer duty talks about consumer personas, understanding those personas and engaging with customers. So I think that really will go a long way within the realm of collections as well. So I think having those, having internal systems, first of all, that talk to each other, that can stitch that, data layer very, in a very concise way, so that we know what the internal data that we hold on customers looks like, and then combining with external changes into decisioning models will be extremely vital. So I think often the challenge in legacy environments is we don't get to have a 360 view of the customer. So having access to all those data attributes to build that picture internally, and then combining with external characteristics and changes, so that we are able to, engage with customers more proactively in a more sort of looking out for them approach, and, ensuring that there are good outcomes delivered.
I mean, and I suppose just before we move off the economy, I wanted to ask about almost like contingent liabilities, almost like sitting there on the balance sheet where people are sort of gradually falling behind, but they might not necessarily be seen in collections. In collections, we tend to see it after it's happened, and it can be quite reactive rather than this proactive approach. I mean, how concerned do you think we should be just looking at the economy, where things are changing? Because we're in this period of rapid change, and we can fall into lags rather than sort of having leading indicators. I mean, how concerned should we be that there could be a bubble that's coming through? I mean, what's I don't know, when you've been talking with economists, I mean, what's your kind of view on that?
I think yes, the understanding on those early signs of financial difficulty, being able to predict that using let's say changes in internal transaction or behavior patterns, understanding those is going to be very vital, because what we don't want to have is a situation where the bubble really explodes later, and it
Yeah.
manifests into a severe collections problem. So I think getting to those signs, I suppose, is paramount. Whether it's affordability changes or just changes in transaction behavior or utilization externally, and how they are engaging with the product now. So I think synthesizing all of that, which is easier said than done because it's quite complex, synthesizing all this information to draw some meaningful, actionable early engagement alerts, and there's a risk you might get it wrong. So I think the focus is more, should be, in my view, more around understanding behavior and then nudging customers towards figuring out what could be the challenge, and then being there to support changes.
Yeah, I'm going to use the word good outcomes, which is a lead in. I was going to ask Kevin around science consumer duty, which is, I mean, you've already mentioned once on the, I know we talked about it a fair bit. I mean, that's due the end of July. I mean, that's another massive change that there's business transformation around. I know you've been pretty close to it, Kevin. I mean, what needs to be done, and sort of like how ready do you think we are?
So I think there's some polarity here, and I listened into the first session and a couple of the speakers talking about, we're super ready, we've done X and we've done Y. My experience in this sector, having gone through a couple of thematic reviews, supported skilled person reviews, if you're under that scrutiny, you really know what it actually means in terms of some of these outcomes right at the coalface. And are your agents ready, in terms of vulnerability metrics, what measuring outcomes looks like, understanding clients' objectives. And there are a lot of companies out there that are not at that stage. And just in my own sector, just the survey that was published very recently that we talked about, Chris, they surveyed 88 debt advice firms, which included a lot of not-for-profit firms, and 30% not even knowing what the duty was. And literally, we've got a couple of weeks to go. And then 42% not thinking it was important to their business. The FCA have called an emergency session on the 12th of July to the whole debt advice sector, smaller firms, to advise them of what their expectations are by the 31st of July. So it's a sort of salutary lesson for one-man bands, small companies that perhaps haven't been as engaged in this as the very large firms where the regulator focused very heavily in the first part of this process and were involved in the consultations before. So when the rubber hits the road, we've got to be very, very clear. This is a big change. It's not TCF2. And this is very much around capturing, outside in through the consumer's eyes. Will the consumer notice a difference in your service from the 1st of August? And the Financial Ombudsman's joined the fray to say, these are the areas where we're expecting to see a difference. Customer service being one. It's not going to be acceptable to say your call is important to us, but we're experiencing exceptionally high volumes. That means you haven't got enough resource. And if that's on the back end rather than the front end, it's likely to be a sludge practice. So there are some very real consequences of not being ready.
And some of this is going to roll over, obviously roll past the date. But I mean, it's a new way of life that has to happen, almost like after from August, almost like forever, right? I mean, what's still got to be done? I mean, how quickly do you think people are going to come up to speed? Do you think there's going to be big gaps? I mean, what do you think will happen in August?
Well, I think we're on a session called business transformation, which leads into business readiness, which means actually, can you actually see a difference in what's happened when this is deployed? It's not about saying your policy register's up to date and that I've updated the risk register and my compliance monitoring program. It's about evidencing that people who are, and systems that are engaging with consumers are materially different or have been reviewed, including websites. And I have to say, I look at a lot of websites and TCF policies haven't been changed. There is still a lot of, rhetoric on the websites that said we are fabulous, but the underlying messaging isn't quite the same. So it's a lot more than just superficial change. And I do honestly believe for the consumers and the FCA now has a consumer-facing website, if they're told this is what you should be expecting from ombudsman, the regulator, then I think there will be a proportion of consumers that turn around who are used to experiencing poor service. And this is exemplified, Chris, again, through the joint regulator statement last week from UK Regulators Network that includes the FCA, Ofgem, Ofwat, Ofcom, that the cost of living is here. Most people have multiple debts. You need to be taking a joined up approach, and that should be benefiting the consumer, not yourselves. And there are some big firms, some big water firms and others in trouble at the moment that have been told to go and pay substantial amounts of money back to consumers for poor service post-COVID. So everywhere you look at the moment, it looks like there's a lag in terms of state of readiness.
Yeah.
And there's some big shocks if regulators are going to levy significant fines, but also reputational messaging that never is going to do well for a firm that's got shareholders and stakeholders.
Yeah. So Dan, I was going to come to you and just ask, obviously, you've been taking a digital approach to collections, as being a regulated firm as well. Then obviously the duty applies. I mean, what's your view in terms of like how that kind of fits in? And I know you already mentioned around that you still got an outlet to try and talk to people. I mean, what's been your kind of take on the duties that sort of flows through, but also the role that digital can play in terms of generating good customer outcomes too?
Yeah, well, I think in terms of implementing the duty, I was feeling very confident until I spoke to Kevin for 10 minutes, and then he's swiftly whipped me back into shape. But yeah, so I know from our side of things, we've done quite a lot, and I know that because the digital aspect doesn't necessarily hold that back, but I think what it does give us, it gives us a lot of data that we're able to process and look at in terms of tracking and monitoring those outcomes for customers, which gives us a lot of room to improve. So I think that's definitely a strong point of ours.
Okay, I mean, and I suppose as we talk about more broadly around business transformation, I mean, what do you think the balance is between, I suppose, digital, self-serve versus manual, and how does that kind of fall in the mix? Because I think part of what we're saying is, like you heard on the last call, is making sure that you can get hold of someone if you need to, but then also there's also the convenience factor as well. I mean, I think even you've mentioned that on this call already.
Yeah, so I think for me, obviously, I'm a massive fan of self-serve digital customer journeys. So if those journeys are mapped out and planned well enough and easy to navigate for customers, you'll find that they can and will do that. But on the flip side, you also need to make sure that they're able to speak to someone when they want to speak to someone. Like Kevin just gave the example there of your call's important to us, you've got to wait X amount of time. That's frustrating for somebody, especially in our world, if they had to listen to that when they've made an effort to engage with us to resolve an outstanding balance. That's very frustrating and can make the conversation a lot more difficult. So I think the transition between the self-serve journeys into the conversation, I think if you get those right, and that doesn't necessarily have to be phone. We find transitioning into a web chat or transitioning into WhatsApp or text message, whatever that looks like for a customer, if it's simple and straightforward and they're able to do it, then it works. And then obviously when they're speaking to that agent, the agent needs to be best positioned to help. So make sure they're getting to the right person at the right time. I know one of my bugbears is going through multiple departments before you speak to the person that you need, getting transferred between. That's one of mine.
And I suppose, Neha, as we think about, will there be a shock to the economy, or like a big shock to the economy? Will that result in increasing volumes flowing through the collections process? I mean, how do we need to think about digital as a role to play in terms of helping manage that volume? And I suppose particularly I wanted to ask the balance between almost like taking cost out versus, using digital to get better information or better treatment, or using it to basically to collect more as well. I mean, how should we sort of think about what the balance should be between digital self-serve versus having the agent on, etc.? I mean, what's your kind of thought process around that?
I think Digital definitely in the less complex early stages, something to what Daniel also mentioned, big opportunity within collections to digitally self-serve. And I think when you have those early signs of stress, or you're just behind your payments and you're just a sloppy payer, digital nudges, encouraging customers to remind them of what action is expected can really work very well. Or situations where the financial challenge being faced is not very complex, and it's a short term financial difficulty where there is a possibility that the situation will change in the next 3 to 4 months. In that scenario, thinking digital first, offering solutions, understanding the situation, or more color, more qualitative understanding to the situation via digital means could really help in order to give that short-term relief to the customer. So I do feel digital almost is an enabler throughout, but more so within the very early stages of financial difficulty.
I mean, there's a question asked around whether we can deliver forbearance digitally, and this is maybe something that's kind of going to divide us a little bit in terms of, like, I mean, Dan, I'll go back to you in terms of comment around, is it possible to do that journey sort of digitally, and when do you sort of trip over to having that conversation with someone versus having it almost like completely self-serve? And then Kevin, I'll ask your view, because I know you've got a lens on it as well from a debt advice point of view. But Dan, what's your kind of view on it in terms of like how to think about that balance?
Yeah, well, I think first, obviously, just to clarify, digitally, that could mean that you're talking to a human being at the other side. So we're talking WhatsApp, web chat, conversational SMS, whatever that looks like. You're still talking to a human being at the other side, and what we find is that communication channel opens the door for people to be a lot more honest and frank. Something that they might find a little bit more embarrassing to discuss on the phone, they're able to type down and send in a message in a bit more of a relaxed communication form. So I think that works. In terms of the forbearance, I think that it works exactly the same, because the customers we're dealing with on a daily basis, we're having these conversations via a digital contact channel, and we're talking and discussing through the exact same topics that we would be on the phone. It's just we've found that the customers we're engaging with, they're preferring to do it in that way. And like I have mentioned, that we do have the phone capability there. So if it is at any point within that conversation, it becomes apparent that we need to speak to that customer to move this conversation forward, we can do. And again, that's just down to where the conversation leads. But yeah, with the forbearance stuff, I personally believe, and I've seen that customers are a lot more open to going into that little bit more detail that we need at times like this. We need that little bit extra detail to be able to help properly and effectively, to make sure we're not just kicking the can down the road. So yeah, that little bit of extra detail really does go a long way.
I mean, Kevin, what's your kind of view in terms of, like, I suppose, agent involvement, telephony involvement versus digital agent involvement, so non-telephony involvement versus self-serve? I mean, where's the balance of that, and how does that fit into, I suppose, the duty in particular as well?
So I think if we go back to the sort of behavioural science part of it, I'm probably entirely with Dan that where it's the right channel for somebody, allow them to engage, and that from a duty perspective is you want an equivalence of quality across all your channels, whether that's omni-channel or multi-channel. And I do agree that there will be an element here where somebody, particularly if they've been contemplating doing something for well over a year, which all the evidence from Step Change, Pay Plan, Christians Against Poverty is suggesting people have been doing and thinking about this for a long time. So there is a big population there that it isn't a short-term problem, quick fix, go into collections, come out again. This has been building for a while, and the tail of it's likely to be there for a while. And forbearance is difficult, particularly in the DCA world, because many of them are driven by get an outcome within a certain period of time, maybe 3 months. And we really haven't come up with a proper solution yet that combines with things like breathing space that said, who is the right person to caretake a client for a period of time where you're not going to get blood out of a stone, but you may well do in due course? Is that going to be a digital DRA who actually looks after the client, identifies the change in circumstances, the barometers of change that said, right, we now need to reapproach, but with a view that we're going to discuss some form of sensible time to pay. And many of the firms that are emerging at the moment use a blend. So if you look at something like Reach Out, it's there not to do any collections work whatsoever. It's just to re-engage with the client, to get them to really understand the process isn't as painful as perhaps they thought it was, and to recognize the fact that they have got multiple debts, to size up their position and look at their options. So I think, again, going back to the cohorts of clients, I'm a big fan of digital in the right place. I'm also a big fan of mixed journeys where nudges take place through different channels. Big fan of the fact that 84% of the population have got a smartphone, and that does SMF, WhatsApp, it does, online, it does, portals, it also does digital documents and signature, and it's a phone as well. Yeah, and each one of those can be used to its greatest asset, where it's a pro versus a con. But forbearance is a toughie. And at the moment, we've still got a lot of work to do, particularly aligned with the FCA messaging around the use of breathing space, to say, how do you encourage people to actually engage? Is it a safe haven? And if you are going to, as Dan's indicated, actually engage with proper evidence in that environment before you start sharing data with others, that to me is the next big logical step. Tell me once, and the data sharing safely, and what are the benefits to me from a consumer perspective? And that's where the duty is important. What are the benefits to the consumer rather than it being an OPEX saving to many of the creditors?
So I mean, certainly on digital versus manual, or agent versus self-serve, as an example. I mean, I seem to have had conversations on both sides of it. Some people have sworn blind that you've got to have an agent involved. Some people said, well, you can definitely do it 100% digital. It feels like, even what you guys were saying is it feels like it's somewhere in between, and it's a lot more complex. And we're having this, we tend to always view the world in this quite sort of binary kind of sense of one or the other, but it seems like it's a little bit more complex. I mean, are we looking at the right indicators? And Neha, I was going to come to you around, what other indicators should we be looking at? I mean, is that an indicator we should be looking at? I mean, it feels like even with the new technology that's coming along, we can look at a lot more less simplistic kind of indicators to almost like sub-segment our portfolios and create different business processes that are much more tailored around individual customers, which I suppose is where consumer duty is trying to get to as well. I mean, are there indicators that you think we should be looking at or are going to be important in the future, maybe for things like looking at different segments that can impact our collections processes?
Yeah, I think indicators around, definitely, what's the financial challenge? Is it short term, long term? What's expected, with the customers' income stream, cash flow to happen, layering that in, and then what's the preference? How do they wish to engage? So, and I think more importantly, for any customer segment, we need to have that layer of, figuring out, was the outcome good? So, what does good look like in each of those collection sort of phases, if you like? So I think measuring that, ensuring that whatever treatment has been offered is something which is sustainable, an indicator to say that we solved the problem correctly for the customer, would be really valuable to make sure, what outcome did we generate, and then how did that resolve the situation? So I think some thinking around those outcome-based indicators for the concerned customer segments entering collections, because intrinsically the segments that enter collections from a credit standpoint are those who probably have a short-term problem, a long-term problem, some complex thing going on within their situation, or layered with affordability and general indebtedness. So it's building that picture, but at the same time, understanding the outcomes.
Yeah, I mean, and Dan, I was going to ask you just around, I suppose, you talked a bit about digital can be a good way of sort of getting engagement for some segments, and I say that's probably a sub segment of it. But then I suppose just in terms of like, what's the, how are you measuring, I suppose, in evidencing outcomes? Because you've got a new stack. How do you look at that? How are you thinking about measuring outcomes within the collection space? I mean, what is a good outcome as you're trying to include it to be able to evidence it?
Well, for us, we're kind of heavy on that from day one that a good outcome isn't necessarily always a payment. So for us, there's all pretty much every other. Have we managed to get to the customer to a certain stage within that initial conversation? Whether that's a breathing space, signposted to a debt management agency, those are all positive outcomes for the customer at that time. And then it's about having your strategies in place about re-engaging after that to can you promote a payment plan later down the line after you've had that initial conversation around breathing space, or because there's a lot of tools out there now that you can refer customers to, as mentioned a couple of times as well. So yeah, outcome to us, a positive outcome to us isn't just a payment. You've got to look at the customer and who you're dealing with there and then, and where you're getting them to.
And how do you convert that, I suppose, tangibly into something that can be evidenced? I mean, do you look at that in terms of, reporting that comes out? Is it, like number that's signposted? I mean, you like payments, but like different types of signposting, like length of time they'll get through through agreement.
Yeah, so that's one of the things that Tom, the operations director, is working with the development team. It's about pulling all that data we have around the different touch points into a tangible report that we can look at and see how these customer journeys have ended, and where they're currently sat in terms of the status within the CRM. So yeah, we've pulled all that into a report. It's not 100% ready yet, but yeah, that's definitely something that we're looking at, because that's how we're going to be able to evidence and track this moving forward. So it's important that we get that.
And in terms of, I suppose, business engineering, I suppose, with business transformation, but in the light of consumer duty, Kevin, I mean, like, evidencing is one of the things that's definitely coming through. KPIs and associated with that. I mean, what's your assessment around readiness of that? I mean, I know we've got a lot of suites of standard measures that are out there, but do we need to rethink about the measures we've got? Just a damn point. I mean, what's your thoughts on that?
I think we need to continually do that. So I'll just build on some of the points that Dan was looking at there with regard to the journey metrics. Not everybody is coming in and wants to make a payment directly. Some of that, there's a sparring process. There's a learning process. So some of the information you get out of all the tools, and I'm sure many firms do this already, but the open rates on SMS, the open rates on email, all give you a lot of behavioral science behind why is it that nobody's following the call to action. How do you use that? And this is where you're seeing firms use intelligently machine learning, AI a little bit more to build these personas that Neha talked about earlier on, and to use those more intelligently going forward. But you've still got to learn. Let's face it, there are a number of firms that are likely to get to the 31st of July by the skin of their teeth. And therefore, a lot of some of these system changes will only provide benefits 6 months, 12 months down the line, as you can benefit from the new learning. But all touch points, all the recording needs to be there, particularly to identify worse outcomes. And let's face it, in debt recovery, won't pays and non-engagers are almost always going to get a worse outcome than somebody who does engage. So how do we message those people? If we know that they're actually opening the SMS all the time but not reacting, to actually send messages around the consequences of non-action or what will happen next, not in a threatening way with the scales of justice or a gallows on the top of a letter, but more subtly in terms of these are the nudges that we should be looking at to say, look, you do get a better outcome if you do this, this, and this, and don't highlight the negatives all the time. And that's a lot of the key elements around not only outcomes, but consumer understanding. And so there's been a lot of discussions around things like English not first language, people with particular vulnerabilities, let's say dyslexia. Are you going to use a different medium to get your message across? And indeed, if you as a DCA are not getting the outcomes you want, don't cause the escalation to the next stage in debt collection. Keep it at that level, because you couldn't engage with that client effectively. Somebody else may well be. And in the debt advice sector, we've got specialists who deal with certain language groups, certain cultures, certain community groups. But as a rule, English not first language is likely to be in that sort of 8-9% of your population. If you're finding that's out of kilter, for example, do something different or work with other specialist parties.
I mean, it's just within that you mentioned AI, and I was going to come on to that just a little bit, just having a forward look kind of view around the next 5 years. I mean, there's been lots of discussion of AI. I mean, Neha, what's your kind of view on it? And there was a, where can it fit in? I mean, Kevin's just talked about a couple of use cases there. I'm also interested in exploring maybe a little bit around just making sure that, I mean, are there dangers out there, things like bias, as an example, machine generated data for validating models? I mean, there's a couple of things that are actually could be quite concerning outside of what's in the media. I mean, but what's your kind of role on the positives and potential dangers that we might have in the next 5 years around things like AI and under business transformation?
I think scope of AI ML was always there for the credit industry as a whole, but in light of consumer duty, I think it's even grown, because AI could give you quick synthesis of data to say what's been the outcome that's been generated, does it fall in line with what's been defined as good or not. So there's potential to understand and synthesize customer engagement and what outcome have we generated here at scale. There is also a huge potential of AI to be used, within predicting customer behavior, predicting signs of financial difficulty, predicting is the customer likely to sustain the solution that we've given. So there's a lot of value that one can derive by just figuring out, did our actions really support the customer and generate that outcome. So I think that's one area on the positive, and I see that as a huge positive. The negative, or the watch out, if you like, Chris, what you touched upon, machine bias. So there's a lot of talk about, bias that can be generated. So now there is also this emerging field of, bias elimination as well, using machine learning. So that's also developing. But I think the bigger piece is having democratization on the understanding of what AI and ML is doing for the business. So, it can appear very complex, and for the agent on the front line, understanding how this, recommendation was made, or how this action was taken, why it was taken, having that understanding on what's the AI or the ML doing, what's the model doing behind the scenes, that would be very vital. And I would also say at a senior leadership level as well, understanding how AI and ML is being incorporated, that would also be very critical. And looking ahead, I just feel, there will be a lot of, I think there should be a lot of focus on operational sort of resilience of what decisions are made using AI. So I think it's a dynamic field. There's a more to come, but clearly room for AI to play within the domain of prediction, predicting customer behavior and synthesizing huge pieces of information at scale.
I mean, so as in looking forward, I mean, Dan, you take quite a pragmatic approach to the whole sort of digital servicing kind of aspect to it. I mean, what's your view around what the next 5 years is going to sort of hold for us in terms of like where things move forward? Because look, 5 years ago, it's already changed night and day in terms of some of the stuff that you guys have done, right? But it's like, where do we go from here, do you think?
Well, I think in 5 years' time it'll be completely different again. But I think I agree with Neha on the AI front, that I think that's best placed almost in the back end, predicting and looking for patterns and looking at that overall behavior, allowing you to get smarter with your strategies and pinpoint specific customers and with certain contact strategies, I think that's definitely where AI is best placed. I think the easy answer would be to how is AI going to incorporate into your chatbots and your automation on that front. Obviously, Chris, you know me, I'm very skeptical about chatbots anyway. I think every engagement I have with a chatbot is a negative one. So AI could potentially improve that. So yeah, I think there's a lot of room for improvement in that space. But I think for me, I'm most excited about probably the API front, sharing data between organizations. It's something we do a little bit of already in terms of the vulnerability registration service, the debt respite scheme. So at the point of load, able to identify flags, recognize customer circumstances at the point of load, and then tailor specific contact strategies to those guys based on the information that we've got. And I think that is an area that can massively improve and massively grow. How that happens, I don't know. But I think that's an exciting place to be.
I mean, you are right. Sometimes you get sidetracked by these really super interesting things are going on, but there's also some quite pragmatic things we can do in terms of just actually sharing information and using that can be quite informative. Or it's almost like easier wins to a certain extent.
Yeah,
without the complexity. I mean, and then Kevin, I mean, you might have a slightly different take in terms of like, if we look 5 years out, I mean, what are the key things people are going to have on the register in terms of like where they've got to transform their businesses? What do you think will be the topics we'll be talking about then? You're on mute, Kevin.
Well spotted, though. I think that was the cause of the feedback earlier on. I'd just go back a step on the AI. So I think there are a number of aspects that are going on now. So I'm involved with the Innovate UK project with Amplify Global that Step Change are involved in, following their mixed messages. They're likely to become a gamekeeper for the regulator regarding understandability. That heavily uses AI. And we've played around with this, Chris, with things like, the various tools at the moment, the chat GPT, the bards, etc. I do think there are going to be some real powerful developments here that still involve human beings, but around agent assist tools, robotics included in this, either at scale. So when you're dealing with some of the big Gartner companies doing, vulnerability identification, or at least nudges for agents to ask the right questions, down to a much more granular level where we walked, and you've had people like Nisio AI on here before, where they've got relatively robust technology using tools that people like a smartphone, to do a job that is painful doing manually, that can be dealt with relatively easily verbally. So I think we're going to continue to see an evolution of a lot of these technologies around the whole test and learn, continuous improvement rather than big bang, and that they will subtly improve a lot of the more complex tasks that agents are having to undertake. So practically in my space, debt advice, we found that debt advice sessions were getting longer and longer. You had to embed more drills, do more work, more due diligence. But there's now a lot more intelligence in those processes. There's the role of open banking. How do you pull the credit information in the VRS data, as Dan's talked about? Your invest, income, max, entitled to, policy and practice processes. People are getting smarter and smarter in how they're doing that. AI's got a role to play in that, around the personas. How do you pick up early that somebody should be communicated with at the reading level or a literacy level of 11 versus somebody who's got A-level language? And that's a combination of data analytics, agent skills, external data. So my view over the next 5 years is we're going to actually mature some of these, and we're going to see more and more use cases that are scaled rather than sort of little pilots where something's worked effectively in the specialist support unit. But scale is important, certainly for some of the bigger providers that are impacted by the duty, because they've got tens of thousands of agents. For small, medium size, it's about size of wallet, really. And some of these cloud technologies, consumption-based pricing, and many firms actually changing their commercials in terms of how they deal with digital resolution firms and debt recovery firms to allow them more time with certain segments of their clients to build that rapport and engagement. So there's a number of factors there, some of which are commercial, some of which are technological.
Yeah, I mean, it does feel like there's almost like a new theme that's being sort of injected in the process, which is now going to cause more changes, and it'll maybe take a little bit of time for us to adjust to it in terms of where it generates efficiencies, maybe allows us to spend more time with customers in one spot versus another, as it sort of like flows through. I mean, there's going to be a lot of change, I'd imagine.
Well, regulatory intervention also causes problems, Chris. We've talked beforehand around things like the debt packages ruling. Whilst many agree that the action taken against 33 firms was warranted, there are 19,000 firms with debt counselling permissions. 1,000, it's their primary business. Now, if you've invested a lot of time in the technology to go and do digital and all of these other services, you've got to be remunerated in some way. So we've got to be wary that regulatory intervention doesn't stop people investing in R&D and some of these technologies where you require specific regulatory permissions.
Yeah, I would also say I think the regulatory intervention has also generated a lot of the things we've seen as well. I mean, so it becomes a catalyst to generate a lot of investment elsewhere as well. I see Colin's advised, but Neha, I just wanted to give you one last session, just in sort of like 3 bullets in terms of, if you look forward outside of the AI piece. I mean, what if you got your almost like your risk register in terms of like from an economic point of view, from a credit risk point of view, what do you think are the top 2 or 3 things we got to be worried about?
I think definitely understanding consumers better. there's a lot of dynamic movements here within the economy and otherwise. So understanding, having a clearer picture, and then making sure the outcomes or the strategies or the decisions that we are taking, either using some scoring model or otherwise, they are the right things. So making sure it's working in the right way for the customers. I think that's really paramount from a credit risk perspective and otherwise too.
Okay. Well, fantastic. So, well, Dan, Neha, and Kevin, thanks very much for joining us. Great topics to discussion. And I think there's one thing for sure around business transformation is it's going to carry on. So I think we haven't seen any sort of slowdown on it. So really appreciate the input and the conversation. So Colin, I'll hand back to you.
Yeah, thank you, Chris. Yeah, no, thank you, panelists. Really, really good, really interesting. Like I say, it's ongoing. There's regulatory stuff going on there as well. It's just a real mix of everything, and just trying to adjust all the time to the changes which are still ongoing, which is interesting to talk about, but also quite challenging as well. So, but really, really great insights there. So thank you to our panel. We're now going to have a quick break for around about 10-15 minutes, or just 10 minutes or so, where we'll have our next session, which is going to discuss customer engagement. So people who want to join that, please do so in the next 10 minutes or so, and we'll see you on the next session. But for now, I'd like to say a big thank you to Neha, Daniel and Kevin for their insights, and obviously Chris for chairing, and we hope to see you at a future session or event soon. So thank you very much. Cheers. Bye-bye.